This is a $47 billion aerospace company, and most investors have never heard of it. It doesn't build planes or engines. It makes something far more boring, and far more profitable: replacement parts. The exact same jet engine parts the big manufacturers sell, except this company sells them for 30 to 50% less. And by doing that one unglamorous thing, it has quietly beaten the S&P 500 for more than 15 years. That company is Heico. Last quarter its sales jumped 25% and its profit jumped 49%, both records. So how does selling cheaper parts build a $47 billion compounder, and is the stock worth its rich price? Let's run the numbers. Start with what Heico actually does, because it's two businesses in one. The bigger one is the Flight Support Group, about 2/3 of the company. It makes FAA-approved replacement parts for jet engines and aircraft, repairs components, and distributes aftermarket parts. The smaller one is the Electronic Technologies Group, high-reliability electronics for defense, space, and aerospace, where failure is not an option. Together, they make Heico a niche parts machine. Not the glamorous prime contractor, but the company that supplies the small, critical, certified pieces that keep aircraft and satellites running. It's a business built on thousands of tiny, defensible products, not one big program. Now the heart of it, 3 letters that explain the whole company: PMA. PMA stands for Parts Manufacturer Approval. It's an FAA certification that lets Heico legally make a replacement part for a jet engine, a part the original manufacturer would rather you source only from them, at full price. Heico makes that identical, approved part and sells it for 30 to 50% less. Here's why that's a moat. Each approved part is a tiny, recurring annuity. Airlines need replacements for the entire decades-long life of an engine. Heico is the largest independent PMA maker, with the broadest catalog, and every new approval adds another stream that compounds for years. It's not one big moat. It's thousands of little ones. And right now, the timing could hardly be better. Because Boeing and Airbus are behind on delivering new jets, airlines are flying their existing planes harder and longer than ever. Older planes need more maintenance, more replacement parts, more repairs. And cost-conscious airlines, squeezed on margins, are increasingly willing to choose the cheaper certified alternative, exactly what Heico sells. So the same shortage of new aircraft that frustrates the airlines is a direct tailwind for Heico. The longer the global fleet stays in the sky, the more parts wear out, and the more of those parts Heico gets to supply at a discount. It wins when planes keep flying, and right now, they're flying a lot. So how does all of that show up in the financials? In records, across the board. For the second quarter of fiscal 2026, net sales rose 25% to a record $1.38 billion. Operating income jumped 41%. And net income surged 49% to a record $234 million, or $1.66 a share. Best of all, 18% of that growth was organic, real demand, not just acquisitions. Operating cash flow rose 43%. This is a high-margin compounder firing on every cylinder, and quietly setting records while almost nobody watches. If you like aerospace compounders, subscribe. Next is the big one this whole series has been circling: GE Aerospace, the engine aftermarket annuity. Let's look under the hood, because the two segments tell the story. The Flight Support Group, the PMA, repair, and distribution business, grew 21% to $929 million, with organic growth around 19%. That's the cost-saving parts engine running hot as airlines fly older fleets. The Electronic Technologies Group grew 34% to a record $460 million, on strong defense and space demand. So Heico has two tailwinds at once: a commercial aerospace aftermarket that benefits when planes fly longer, and a defense and space electronics business riding rising military budgets. Two engines, both accelerating, which is exactly why the whole company is compounding the way it is. Now the real secret, and it's not a product, it's a method. Heico is a serial acquirer. It buys small, niche aerospace and electronics businesses, dozens of them over the years, runs them in a decentralized way, and lets the cash they generate fund the next deal. In 2023 it bought Wenser for about $2 billion, expanding its parts distribution. And the whole thing is run by a family. The Mendelsons took control in 1990, today Lawrence Mendelson is executive chairman, and his sons Eric and Victor are co-COS. That alignment matters. Family owners think in decades, not quarters, which is exactly how you compound earnings at 15% a year for 30 years and beat the market. So who else plays this game? Let's lay out the field. The closest comparable is Transdigm, same DNA of proprietary aerospace parts and aftermarket pricing power, but much larger and structured differently. Heico is the largest independent maker of the cost-saving PMA parts specifically. Around them, Howmet in engine airfoils, Curtiss-Wright in defense electronics, and the smaller aerostructure players. But the real competition is the original equipment manufacturers themselves, RTX, GE, and Safran, because the aftermarket is their profit pool, and Heico's cheaper parts take a slice of it. That's the central tension. Heico's whole edge is undercutting the giants on price, and the giants would very much like that to stop. So far, the airline's hunger for savings has kept Heico winning. Now the catch, and it's the price. Heico is worth about $47 billion, it hit an all-time high this month, and it trades at something like 65 times earnings. For a maker of aircraft parts, that is a steep, software-like multiple, well above the aerospace average. So why do investors pay it? Because this has been one of the most consistent compounders in the entire market, 15% earnings growth, year after year, for decades, with a recurring aftermarket that just keeps building. But make no mistake, at 65 times earnings, a lot of future compounding is already in the price. The quality is not in question. Whether you're paying too much for it is the whole debate, and a sharp air travel downturn would test both the earnings and the multiple at once. Let's put it together. On one side, a $47 billion compounder that's beaten the market for 15+ years, selling FAA-approved parts 30 to 50% cheaper than the giants, with record 25% sales growth, 49% profit growth, 18% organic growth, 2 accelerating engines, and a disciplined family at the helm. On the other side, a 65 times multiple that prices in years of flawless compounding, the original equipment makers defending their aftermarket, and an air travel cycle that, in a downturn, would hit parts demand and the valuation together. The franchise says exceptional. The price says don't trip. So where do I land? In my view, Heico is one of the highest quality compounders in the market, a genuine machine that turns thousands of tiny, certified parts into a recurring annuity, run by owners who think in decades. The Fly-Longer Tailwind and the defense leg are both real. This is a wonderful business. But the price demands respect. At 65 times earnings, you are paying in full for the compounding to continue, and any stumble, or a real air travel downturn, would hit hard. I'd want to own this franchise, I'd just rather own it when the multiple isn't priced for perfection. The business compounds for decades. The entry price decides how much of that compounding ends up yours. My base case for the next 12 to 18 months, organic growth stays strong, both engines keep accelerating, the bolt-on machine keeps buying, and the stock trades on whether that compounding can justify a rich multiple. Watch 4 signals. First, organic growth. 18% consolidated last quarter. As long as it stays double-digit, the engine is running, a slowdown is the first warning. Second, flight support momentum. Up 21%, with airlines flying older fleets and adopting cheaper PMA parts. Watch new part approvals. Third, the electronics leg. Up 34% on defense and space. Watch it hold as budgets shift. Fourth, acquisitions and leverage. Net debt is about 1.7 times earnings before interest. The deal machine is the compounding lever, watch the pace and the discipline. Upstream, Heico depends on FAA certifications and a steady deal pipeline. Downstream, it sits inside the global fleet and the defense electronics base. The catalyst that lifts it, the fleet flying longer and the bolt-ons continuing. The one that breaks it, a travel downturn meeting a 65 times multiple. Heico is the $47 billion aerospace compounder hiding in plain sight, a company that beat the S&P 500 for 15 years by selling FAA-approved jet parts 30 to 50% cheaper than the giants. That PMA catalog is thousands of tiny recurring annuities, and a shortage of new planes only makes existing ones fly harder, selling more parts. 2 engines, cost-saving aftermarket and defense electronics, are both accelerating, run by a family that thinks in decades. The catch is the price, about 65 times earnings, with the cycle and the original equipment makers as the risks. The bull case is one of the best compounders in the market. The bear case is the price you pay to own it. One stock, all the numbers, no hype. I'm Big Z, follow me, see you in the next deep dive.